Welcome to the Market Enthusiast podcast, where Good Life's Noah Brooks, Chief Market Strategist, and Chris Needs, Senior Research Analyst, break down today's topics, covering their impact on the economy and personal finance in a fun, easy-to-understand way for investors of all levels.
Hey, welcome back to the Market Enthusiast. I'm Noah Brooks, and obviously this is Chris Needs.
Hello.
What do we got today? We are moving and grooving. We have a trade deal. First one?
Yes, third largest economy, U.S. and Japan came to a deal. 15% tariffs, and for them coming to our market, doesn't seem to be any for us going into their market, and they claim they're going to open up their market to more of our businesses, a $550 billion investment.
Yeah.
I think it's mostly centered in pharma and semiconductors.
Yeah. So we've had some bouncing around. I think there was a trade deal talking about yesterday in the Philippines, but this is really the first.
And Indonesia.
And Indonesia, yeah.
Yeah.
Well, is that very similar?
Yeah.
Yeah. But this is really the first one that we've seen from a major developed
G7,
nation.
yeah. I guess UK is that's a framework, but
we don't have a deal yet.
Yeah.
Although just as we were coming in here, it kind of came across the wires that there was something going on
with the EU.
with EU.
The EU, yeah.
Yeah.
Rumors of I think the rumor swirling now is that they're closing in on a 15% tariff. It sounded like, again, vague rumors right now, but 15% both ways.
Yeah. So, I mean, obviously we had crazy markets back in April, but this deal, and not just this deal, is we're sitting at new highs. As we walked in here to record this, we are at all-time highs on a lot of different indexes. Certainly the S&P 500, developed international. I don't know where Japan is. They probably had their all-time high back in like 1982 or something. But developed international is at all-time highs when you look at that. And now it seems like there might be some other dominoes to fall in here, whether it's the EU, whether it's Canada or Mexico, or even some Latin America countries. I mean, it feels like this thing could actually happen after nothing happening for, really since April or May.
I think everybody was trying to maximize their leverage, and as long as that first domino didn't fall, they didn't feel pressure, and Japan went. Now EU the very next day is closing in on a deal. The dominoes are starting to fall, and no one wants to be left out alone in the cold. So I think this will increase some of the pressure on, say, Canada, who was going towards a recession to begin with.
Yeah.
And probably Mexico as well. Canada seems to be pushing back pretty hard, but again, they don't want to be left out with their southern.
No, nobody wants to be left out.
Their southern border, country not doing a deal with them.
Yeah. So what do we really know? You said 15%. Now, I think the auto parts and cars in general being imported from Japan were currently at 25. Now, maybe they're going to lower it today, but maybe there's a date. But what else do we know besides that?
I don't know too much. I mean, all we know is the markets seem to like it. They're taking it. Before we came in here, the Japanese ETF, country ETF through iShares, I know was up, almost 5%. So that market's responding. We looked at developed. International is responding pretty well. We have the EFA at all-time highs, while the S&P 500's at all-time highs. That hasn't happened since 2017, which was, if you remember, that was the year where, I don't think we had a 5% drawdown the whole year. It was probably the least volatile year ever.
Yeah, like 4.7 or something was it.
We would like that to continue. These all-time highs, simultaneous global growth is good.
Yeah.
Or at least price appreciation.
No, absolutely. There's no question about it. Now, our forecast, if you will, for the year end at the beginning of the year was up 8 to 14%. And we, like everybody, called for a drawdown in the middle of the year. We kind of said around 20%, and that's what happened. We're back at all-time highs today, obviously, with this deal. The S&P 500 is up about 8.5%. Value as of when I last looked, the value side of things is actually outperforming just about a 0.5% or 0.25% year to date over growth. And when you look at the growth chart, it's not, even though we were at all-time highs last week or earlier this week, growth isn't responding today as much as the value side is.
Yeah, it seemed to stall out a little bit the last couple weeks, and yeah, we're not seeing the movement today either. We see the Dow up, certainly, which again, now there's like Nvidia in there, so you can't say that's like an old value index, but it still has a lot of those components in there.
Yeah, no question about it. They do take a lot of them out and replace them with some very well-known names. I don't know if that's the best thing to do in the Dow Jones, but nevertheless, I mean, again, all-time highs, here we are, and everything seems to be working, although tech not working exactly perfect today, but it just seems like we're setting up for a positive year end, even if we get some pullback in the middle of that, right? You know, so I wouldn't surprise me at all to see a 5 or 7 or even 8% pullback between now and the end of the year. It seems like that's the case. And with tech, not so much that it's rolling over, it's just kind of losing some of the momentum that's been there over the last 2-3 months. It seems possible that we could get at least a 4, 5, 6% pullback here in the near term.
Yeah, going sideways for tech would probably be one of the best things that could happen.
Yeah.
So a drawdown, I would say, potentially, likely. But if we just went sideways, sort of how we've gone the last 2 weeks, that would be the ideal scenario because they're up, leaps and bounds from those lows.
Yeah, no question about it. So I think we're going to learn more, obviously, as the days goes on, and I think there's going to be some other countries that hop on this. Hopefully, the EU will. I'm not 100% sure, and I don't certainly have all the details on existing tariffs versus what the new tariffs will be. But it does seem a little strange to me that we can demand a tariff or negotiate a tariff if there's no tariffs on the other side. So, again, I'm not an expert in tariffs by any stretch. But if we're going to put a 15% tariff on everything that we import from Japan, and there's no tariffs on the other side, that doesn't seem like a great deal for Japan.
I think one thing Trump has done that wasn't really previously done is he's roped in every topic and rolled it into the tariff negotiations. So whether it's military support, which most presidents were operating, the economic and tariffs are completely separate from our military support for them, or different guarantees and alliances and things like that. Whereas Trump seems to have just rolled that all into one ball to increase his leverage, where he's saying to, Japan, we need a sweet deal. You have a really big neighbor who's trying to do some powerful things right next to you. If you want our support, we need a sweet deal. And you could say he's done that with the EU as well, and with Ukraine support. He's bundling up all these things, saying we've been taken advantage for so long. So he's bundling all those gripes into the tariff negotiations, which, again, like I said, I feel like it was never done like that. It was always, we'll negotiate.
Compartmentalize.
Yeah, we'll compartmentalize across the board on our topics.
I haven't heard it put quite like that before, but yeah, I mean, there's something to be said for that. Just broadly, what do you think? Do you think tariffs are beneficial? I mean, there's going to be a dollar value to these tariffs, and likely we're going to be the benefactor of those. But how do you think it plays out over the next, let's say, 5 years? Let's say everybody falls in line and it's 15% tariffs to sell into the U.S., right? For goods that we're buying. How do you think it all plays out over the next 5 years internationally?
Well, just on the headline, I mean, I'm not a pro-tariff person, certainly. I believe in no tariffs, as low as taxes can be. That's just sort of what I believe. I don't know. I think, again, Trump is looking at this from, we've been taken advantage of. This is how we equalize it. And it's likely to be short-term. These aren't tariffs, probably won't make it through to the next administration or beyond. These aren't going to be 20-year things that are just going to stay in place I would assume they're more short term in nature, not by Trump's will. Trump probably wants them to stay on forever, but yeah, it's just gonna decrease profits. And I wonder how U.S. automakers feel about this, because obviously Japan's auto market's very strong. Toyota's a huge, very successful company, and yeah, they're getting 15%, but they can still compete at 15%.
Yeah.
So I'm interested to see how it plays out over the longer term, but I'm not sure they'll be in place for 5 years, as you sort of said there.
Yeah. Well, the market seems to like it, right? We covered that at least today.
Yeah.
At least today.
A little less uncertainty than there was yesterday.
A little less uncertainty, yeah. And that shows. I talked about the domestic markets, but international all-time highs. We mentioned that. Emerging markets, not quite all-time highs, up about 20% for the year, but they still haven't been able to rally to all-time highs. Their all-time highs, I think, were February of 2021. But yeah, I mean, it's certainly possible that we continue to rally on this. Although I would think at some point there's some buying exhaustion, because it kind of seemed like that leading up to it.
Yeah. I mean, it seems like mid caps are doing a little bit better than they were. Maybe a little short-term breakout here. Small caps, they're up and down. They're more volatile. They're up a little bit. We saw a couple things come in the OBBBA that we sort of talked about and we think sort of benefit small caps and mid caps more than, say, the large caps, in terms of immediate depreciation on capital investments and interest expensing, rather than being off of profit, being off of EBITDA, which is just earnings before interest, taxes, depreciation, amortization. So it's a larger number you can basically interest expense off of. I think those less profitable companies will benefit from that, and that's what you normally see in, say, the Russell 2000.
Yeah. Small caps are not even close to all-time highs.
Right.
Mid caps are pretty close to all-time highs. Obviously, we invest in all of them. We haven't made any serious changes to smalls and mids. We have increased our allocation to international and mid-year rebalance, but nothing major, just a few percentage points. Seems to be working out pretty good today.
Mm-hmm.
And for the last few weeks or so, I would love to see the rest of the world continue to move higher along with the U.S. markets, as you pointed out. And what I said last time we were here is, a diversified portfolio is actually working. It's not just all U.S. First time in a while that both emerging markets and developed markets are outperforming the United States pretty handily.
Yeah, this would be one of those months where diversification really helps, when you have, as you said before, Russell 1000 growth sort of topping out. We'll say not topping out. We'll say just, treading water while everything else is still going up. So that's those months where diversification really helps you, because those large cap stocks make up so much of those large cap indexes.
Yeah.
When they're not moving, you got to get your growth somewhere else.
Yeah, absolutely. So here we are. We're midsummer. We're third week of July, and I just have been having a sports summer. Right. I'm changing gears a little bit here, but June and July, I'm not typically a sports guy, but June and July are big international sporting events. I don't do any soccer. Sorry, FIFA people. That's not my game. But we got the Tour de France going on right now. In a little bit of a break from Formula One, but we had the British Formula One. We're coming up on Belgium Formula One during the break or after the break. We just had Wimbledon. So for me, like, June and into July is in my opinion, the greatest sporting, 6 weeks that we have. Pretty excited about that. Anything going on in your world?
I mean, the Braves are having a tough year, so it's tough for me to watch baseball right now. But I will say they had the All-Star game last week, and it was really cool. They were tied. They went to extra innings, which in the All-Star game, they turned into a home run derby, like a home run derby off. And it was kind of exciting. It was cool to see. Finally made that game relevant.
There was a walk-off error, I guess, on the Phils the other day, where a the catcher got his glove.
Interference,
Yeah, a
yeah.
little interference. That doesn't help happen all that often.
2 days in a row, actually. The next day, Bryce Harper was stealing home, and same thing happened. He came like up on the plate, and he got ruled for catcher's interference, not giving the batter attempt to hit the ball to try and tag him out as he stole home. So rare to see that 2 nights in a row in baseball.
Yeah,
especially against the same team.
I watch a little baseball, but not too much. Yeah, not too much. I said where we are here. I should throw out. We had some notable deaths over the last few days, right? Ozzy Osbourne died. I don't know if you were a fan of Ozzy.
Who doesn't love Crazy Train? I mean, I wasn't an Ozzy fan, but Crazy Train's a great song.
Okay. Did you do Black Sabbath growing up?
I didn't. No,
you didn't? No, that was more my my era. Yeah. And then, there's a drowning death, right? Theo Huxtable.
Yeah.
Malcolm Jamal Warner. He was out swimming with his kid
in Costa Rica.
In Costa Rica, yeah. I saw some of the video of where it was. It did not look like a place that you want to go swimming.
Really?
I mean, not to me. I'm not. I can swim, but I'm not I'm not an advanced swimmer. Certainly not an advanced surfer or anything like that. Didn't seem right.
Last summer we were at the beach, and I threw a football to my cousin from like up at the tent, way down, like 30 yards down. Missed him. It bounced, skipped towards my other cousin. The ball was floating. I kid you not, like 2 yards from him. He takes like 2 swims at it, and then he just stops. We're like, what are you doing? Get the football. He's like, it's floating away too fast. It's one arm away from you. And that beautiful GST football is now floating somewhere in the Atlantic Ocean to this day, probably. I miss that football.
It's in Bermuda.
Yeah, maybe someone's like, ooh.
It's in Bermuda. So some other economic stuff going on. We have home prices that came out this morning. It looks like they're the highest home prices in history. And it seems to be slowing down the demand for it. I mean, you have a combination of high interest rates or higher interest rates than they've been. I mean, historically, they're not extremely high, but certainly over the last 10 years, they're high. And pretty high. I think the average price for a house was $435,000, highest ever. So kind of putting the brakes on the real estate market and home buying and selling in general.
Yeah.
I mean, anecdotally, I'm not in the market to buy or sell at the moment. But anecdotally, I look at Zillow a lot, and I see that a lot of the places that are out there are bringing, price reductions and recent price reductions, right? Like July 15th, July 20th, all throughout July. And I was actually, there was an article the other day about Vegas and South Florida and home prices coming down. So I start Zillowing places in Vegas that have a pool. I'm just curious. And that's where I see all of these home price reductions.
Well, you just said prices are at all-time highs. So is that like irrational exuberance on the part of sellers who think, oh, well, we hear every day about how hot the market is, so I'm going to price this here where it's just a level that is ridiculous or doesn't make sense? Is that what you think that's a function of? Is everybody thinks their house is worth far more than it's actually worth?
Well, maybe it's a function of yes, it could be that. I think maybe it's also a function of the demand, right? I mean, we've been in this kind of seller's market for a while where they can raise prices and people were buying. But at some point they hit a wall and there's just not enough people looking to buy at those levels.
Mm-hmm.
With, so we know for years people have been doing a lot of cash buying, right? And now maybe those cash buyers are all bought out and these people are mortgage buyers.
Mm-hmm.
Not that there weren't any mortgage buyers or anything, but there's a lot of cash buying going on. And so you still have mortgage rates pretty high. I don't, the
wages are fine. They're not going up at a quick pace though. So the people who were able to afford those high rate mortgages have probably largely bought them. And now it's the stragglers who are kind of left behind that can't afford a 6-7+% interest rate.
I mean, in 2001, we had an 8.75 rate, but it was not on a $450,000 house.
Yeah.
That's honest to goodness truth. I mean, that was a long time ago. and the mortgage rates were significantly higher than they are now, but it just didn't seem to bite as much.
Mm-hmm.
You didn't have to worry about it that much. And you could still get, in 2001, you could get a lot of house for a reasonable amount of money. Nowadays, everything's priced at the maximum value that they can get.
Mm-hmm.
And maybe that's always the case. It's just that they've, I think in 2000, the average home price was something like 149,000 across the United States. And now it's 435. Quick math says that's significantly faster than the overall inflation rate.
Yeah. Speaking of inflation, we finally got that number. Kind of came out later in the month, 2.7%. So did tick up from the previous month, but it was below expectation. Core was at 2.9 versus 3.3% expectation. So I'll call that in check. Nothing too scary yet. Of course, extraneous events haven't taken place yet per se. There's a lot of buying before, tariffs and the threat of tariffs and everything like that, front loading, but not bad. And then the next day we had PPI come out really cool. I think it was 2.3% versus 2.6% expected.
Yeah.
So that was surprising to see such a cool PPI, right after that. So inflation's kind of in check, and we know all the pressure on J Powell right now.
What pressure?
All that pressure. So I don't know. I think we're in a good spot right now.
I don't think that and we talked about this before on here, but I don't think the Federal Reserve lowering rates would have a massive impact on longer term rates. Obviously the Fed controls the overnight lending rate. The banks can borrow from the Federal Reserve, and that might be good for some businesses. And I say might be, it would probably be good for some businesses. But in terms of lowering mortgage rates overall, I'm just not sure that it would do anything.
Yeah, I don't think it would affect mortgage rates, which even though they're 30-year mortgages, they're still more so based off of fluctuations in the 10-year. But yeah, it would still change the shape of the curve if we still took out some of those inversions that we have in the belly of the curve. So I think that would always help businesses. I think there's a valid case to be made for cutting rates a little bit, not like the president is calling for. But I personally think we're sufficiently restrictive for where we're at, and that there is room to cut. Now we are forecasting. Now it's September, sort of starting to slowly get priced out for no cut, which is kind of surprising. Everybody was consensus expecting that.
Well, you were talking about inflation, and when you look at the core number, it actually rose up a little bit, 2.9%. Housing was a component in there, right?
Yeah.
That's certainly not going to disappear. But I think the overall consensus from the FOMC is that they're just not ready to cut yet. And so we have the situation with tariffs, and I think the further that moves with more countries, if you want to call it, falling in line, deals being made. Like, I think at that point, after a few months, I think the Federal Reserve will go, okay, we're through the worst of it. We haven't seen, if this is the case, we haven't seen these price increases that we're so concerned about. And I think they'll be like, okay, right, now we can cut.
I do think they were waiting on deals to be cemented. So we're slowly starting to get towards that. The deadline's coming up August 1st. And I think that's what they ultimately were waiting on before cutting. Certainly July's not really on the table at all, unless you're Waller, who's trying to vie for a job. But what gets me is they have admitted, J Powell has said from his own mouth, that they understand they wouldn't raise rates due to increases due to tariffs, which they view as a one-time, especially if we have deals locking in at, say, we'll just assume a base of 15%.
Sure.
They would look through that. They wouldn't react to that. So when they say they're data dependent, well, anyone can do that. They're just being reactive to the data. That's literally what they're admitting when they say we're data dependent. We're reacting to the data. And if they've already said they're reading through and wouldn't raise due to the risk, well, then why wouldn't they do something proactive. They're getting paid. They have all the tools available to them that they can be proactive, and they aren't.
Well, I would say that it's a little bit deeper than that. If you look at what the president wants Jay Powell to do, he's saying, cut rates to 1%, right? And that's what would happen under dire circumstances, that whether that's a COVID situation, whether that's a global financial crisis. But I'm not sure that the Federal Reserve doing that would have the effect that the president is looking for. So it might be beneficial in the short term, but what you're really doing is you're increasing access to the money supply, right? So you're increasing the money supply. When you increase the money supply, people have more of it to spend, and therefore inflation generally picks up. So I understand that he thinks it would be helpful, but I'm not sure that he understands the full effects of something like that. And I think it's a miscalculation.
I think it's just his standard, bombastic quote where he's saying that, but understands it can't be that level. And again, when I say that I think they're in a reasonable spot where they could cut rates were sufficiently restrictive, we should go down to like 4 or 4.25. It's not down to 1 or cutting 3% as the president says.
Yeah. Well, it wouldn't surprise me to see Jay Powell and his not so merry minions, give us a 25, and not necessarily in July. Are they off in August?
Yep.
Yeah, off in August, but they can still come out. They can raise or lower anytime, right? We could
They'll
see
be
it.
in Jackson Hole.
They'll be in Jackson Hole hanging out, right? On the dry ski slopes and the green ski slopes. But so September, I would think there's probably a pretty good chance of a 25 in September and maybe another one following.
In Jackson Hole, we'll get the clues like we did, was it 2 or 3 years ago, where I think it was 2 years ago, 2023, where he gave the clue. That's when we ended up in October recovering, sort of jumping back a little bit. Or no, 2022. Where they'll forecast in Jackson Hole sort of where they stand or where he stands.
Yeah. I'd like to see, I mean, if by that time all these deals are in place, I mean, what it does is it gives us more transparency. It gives the CFOs of all corporations more transparency and more of a path, right? You can't really make a decision when you don't know what's going on. And okay, we're going to have 15% tariffs and it's going to work and we're going to move forward. And I think that's what everybody's waiting for.
Yeah.
And certainly the market's responding positively, even though it's, I would say only Japan, but as you noted, the third largest developed economy. So it seems positive.
And we didn't touch on this as we were talking about J-PAL and economic stuff, but we had another good jobs report, 147,000 jobs created.
Yeah.
I forget what the line in the sand is. We sort of kicked around between the two of us where, like, as long as we're above 80, maybe below 140.
Isn't the replacement rate like 75,000?
Yeah, in that range.
Just to maintain.
So that would kind of be the sweet spot where it's not too hot, like 80 to 130-ish would be like not too hot to prevent rate cuts, but not low enough where the economy's in trouble.
Yeah. And I think that's where everybody is. I mean, just full transparency. I kind of keep waiting for something bad to happen. Now, I haven't necessarily acted on that emotion because that's what it is, right? The data is suggesting that nothing bad is happening at the moment. Obviously, none of that is forward looking. It's all
leading economic indicators have been like negative for like 4 years now.
Well, and that's the thing, you can feel a certain way, but that doesn't mean anything from a market perspective. It just doesn't. And you look back, I deal in the charts, and you look back over the last 10 years, I think it's been 7 or 8 drawdowns over 10% and another 7 or 8, or even maybe closer to 10 in that 5 to 10% range. And without fail, every single one of them has been an opportunity to add to high quality positions. Every single one of them. And every time people get freaked out and the market goes down, I don't care if it was April of last year during the regional banking crisis with the Japanese yen. I don't care if it was this year in April with tariffs. Every time people get freaked out, it's okay, I think, to get freaked out and to be concerned. But as a retail investor or an institutional investor, if you're selling at the bottom and the market goes right back up, it is really hard to make up those returns. And for most of our clients here, I think they're better served riding that out. Not every single one of them. And, you can't say it for everybody, but I think most people are better off taking those ebbs and flows and, being less emotional. And in the end, I think it's your long-term returns. If you miss that up 20% or up, I think since the bottom, April 8th, the stock market, the S&P 500 at least, is up close to 30% from the intraday low. So if you freaked out, you panicked, and you waited for something better, whether it's feeling good or some type of data point, I mean, you can't miss an up 30% market.
And by the time you get that data point, the market's already run 10%.
Yeah.
At least.
Yeah. So for most investors out there, I know it can be hard. It's hard for a professional investor, as we are, to ride through some of these events in the market. But in the end, it's about your lifetime return. It's about what did you earn over 30, 40, 50 years of investing. And I say this all the time to people, the difference between a 5% return and a 7% return over your lifetime is going to be hundreds of thousands, if not millions of dollars. And those determinations, whether you have a 5% return, a 7% return, are made by two things, right? Your overall allocation in the markets and what you do when the markets go down. And I would be willing to bet that the latter, what you do when the markets go down, has a bigger impact on your lifetime return than your overall allocation. Now, if you're
definitely agree.
Yeah,
definitely.
So that's my story, and I'm sticking to it. We obviously have some other stuff to go over here, but I think if there's a takeaway from today, that's what it's going to be.
Don't panic sell.
Don't panic sell. Yeah, absolutely. So what other data we have today?
I don't have much on the data side. We sort of went through the economic stuff already, market returns. I'll just say there's a couple interesting points out there. Berkshire Hathaway has been struggling since Warren announced his retirement. I think they're down about 12% since then. Understandable, there's some premium that comes out. We always talked about wondering what that Warren Buffett premium looked like. Well, looking around 12% right now.
Well, yeah, the rest of the market's at an all-time high,
and it's not going up.
Yeah. Was it down today? I didn't know.
I didn't see today. I just know since the announcement, they're down about 12% while the market's been recovering. So it's understandable, though. He's a legend, one of the best. I'm not going to say the GOAT, but one of the best.
I mean, a lot of people think
he has the most notoriety.
Yeah. Who do you think's the legend? Who do you think is the most famous or the most impactful investor out there?
I don't know about impactful, but I'm thinking of Simons. Was that
Jim Simons?
Jim Simons,
sure.
Yeah. He just had insane returns that dwarfed even Warren Buffett over a 30-year career plus.
Yeah.
He sort of in my mind, it was definitely in place before him, and it's come leaps and bounds, but he was one of the first quantitative investors to sort of make it a science, and he did great. Look into him, Jim Simons.
Yeah.
I read a book like 6 months ago about him. It was awesome. Going through the early days, the struggles, figuring out the numbers, compiling data. That was one of the most impressive things they did before we had, all this data readily accessible, that they took all the 5-minute ticks from like 3 decades and put it into their computer manually.
Yeah.
They had a guy just literally in the back.
Well, I'm telling you, I mean, things have gotten so crazy, and not even so crazy, but advanced technology, semiconductors, and now software has moved forward so much. And the miniaturization process, everybody knows the old IBM original computer was big as a house, was in Philadelphia, thousands and thousands of pounds. And you're getting these tiny, I mean, look at our cell phones, right? They happen to be getting bigger. But what did I see the other day? We obviously know there's drone warfare out there.
Mm-hmm.
But the technology in these drones is getting smaller and smaller and smaller. The drones are getting more powerful. The batteries are getting more powerful. There was an article a week or two ago about China and these miniature, it's something out of kind of a nightmare, like a sci-fi movie,
like a spy thriller.
Well, these miniature mosquitoes, and I don't know that they're the exact size of a mosquito, but these tiny drones that in a box, you can put 100 of them, drop them off somewhere, boom, and they go into all the houses to find a way into your house. That to me is right out of some type of sci-fi movie.
I'm more okay with Terminator, humanoid robots than I am with that. That's not cool. I hate mosquitoes to begin with.
I mean, like it, love it, hate it, it doesn't matter. That type of drone warfare and technology is coming to.
So what, they float one of them outside the White House, they find their way in, and then
you have eyes and ears in the White House. I mean, you remember the old stories about the CIA trying to wire up a cat?
Oh my!
Right?
No, I never
to
heard
spy.
that.
Yeah,
that's crazy.
They
wouldn't
obviously
put it past them.
They tried to wire up a cat to go into certain places and have a bug on them, and cats don't really listen that well.
We just had another hack with Microsoft SharePoint technology, apparently, that got infiltrated a lot of institutions and companies. And everything I've heard so far has insinuated Chinese hackers.
Oh.
So.
Well, I mean, so I don't believe that we use SharePoint here, but I know it's a really popular destination to share, spreadsheets and Word documents.
Like a pre-cloud cloud.
Pre-cloud cloud?
Yeah, like pre-cloud, it was like
Inception, the movie? Not quite. No, but if Microsoft can get hacked, and whether it's China, whether it's Russia, whether
doesn't matter who it is,
some rogue nation, or just terrorism, or a terrorist organization, if Microsoft can't stop it from happening, how am I at home going to stop it from happening?
Yeah. We talked about, everyone saw the CrowdStrike repercussions last year, how that impacted also Microsoft. But the repercussions just from one little accent on one little line of code shut down air travel and shut down broker dealers and across the board, all these different companies that you didn't even know had CrowdStrike within them, but because Microsoft partners with them,
sure,
there's a way in there.
You mentioned air traffic this week. I think it was Monday or Sunday night. Alaska shut down the entire fleet because of a software program. Mm. I mean, that's kind of crazy that you have to shut down. I don't know how. I think they're the 5th largest airline in the United States after they bought Hawaiian a few years ago. But I mean, to have to shut down every single flight for a day or two, that rivals the Southwest situation a few years ago, and it's not great.
Lose a lot of customers that way.
Well, I mean, we rely on
plane travel and hotels down in the CPI report.
By how much?
Not much, but
slightly
negative.
Yeah. Well, I'm gonna do my part this week. I have some flights coming up here over the next few months. I'm pretty excited about the travel. I'm going to do a little Spain and England, seeing some family in England, and then a little bit of eating my way through Basque Country. And one of the things that we're concerned about, Ailish and I, there's like a little bit of a anti-tourism feel going on in Europe.
Seen that.
Right? I mean, there was like all these squirt gun things, and okay, I don't mind getting hit by a squirt gun. I don't love the idea of traveling somewhere where you're not welcome. But the thing about it is there's lots of reasons that people travel. For me, it's going to be a little bit of food, a little bit of wine, and some family. But Europe offers incredible arts and historicals, wonderful natural beauty, whether it's the Scottish Highlands or whether it's the Greek islands, and everybody wants to go there.
Party scenes, Ibiza.
I'm not going to do Ibiza. That's not where. I mean, I would. It's not on this trip, right? But everybody wants to go there, and you have these little towns. Like we're hoping in September to stop in Bath in England, and it's a relatively small town. It's named Bath because of the Roman baths that were built there. But you can only fit so many people in there at one time.
Yeah.
And I'm not saying Bath is anti-tourism, but there's a lot of small towns that are becoming anti-tourism in Europe. I don't think we have that problem here. There's a lot going on in the US, but I can appreciate both sides of this story, right? Them not wanting to be overrun by tourists, whether they're Japanese tourists with cameras, whether there's Americans in their camo pants. I don't know that I'm going to wear any camo, but whatever it happens to be, I can appreciate them not wanting to be run over there. But if their stuff wasn't so interesting, we wouldn't be going.
Yeah.
Right?
Why didn't you go when the dollar was a little stronger?
I know. So back in 2000, I think it was in 2010 or 9, we were in England, and it cost $2.10 or $2.12 to buy 1 British pound. And let me tell you, that was expensive.
Didn't you have a $50 breakfast?
Yeah,
like eggs and toast.
Yeah, it wasn't even eggs. It was tea and crimpets or something like that. So we're not nearly in that camp now, but the dollar has been fading a little bit, coming down against world currencies.
We're 6 months since start of the year since 1973.
Wow. Yeah. Do you think now that we're kind of fixing is not the right word, coming to some deals on the tariffs, that maybe some capital starts flowing back into the dollar?
I'm not sure. I mean, you think the higher yields would short term attract capital. It's hard to tell what's driving that, because obviously it went down on some of those headlines of tariffs and things like that, and a little bit of blowback against us from international. It's tough. I'm not going to pretend that currencies are my area of expertise, but uncertainty is bad. If we have a little bit more certainty, maybe we'll see some flows back in, and it's still in its range. So when we say worst start since 1973, I think it was down 10.7% in the first 6 months.
Yeah,
but it's for long term, it's been in a range, which is an upward range, and we were at the very tippy top of that for a long while. We were getting towards like 110.
Yeah.
And that's not where we want to be, but that's that top of that range. And now we're sort of square, almost in the middle.
Yeah.
Right around the average line. We'll see.
You think about it, for the uninitiated, right? The lower the dollar, the more other countries can buy of United States goods and services, right? And we always talk about goods, but I think services are probably our main export to Europe at the moment. And the higher it is, as you just pointed out with my the reverse of my tea and crimpets is a strong dollar. We can buy a lot of international goods, which makes it harder for that trade balance to get sorted out, right? Yeah. So I think medium dollar is probably the best thing for international trade.
It supercharged international returns, obviously. So whenever us in the U.S. are looking at our returns, we're looking at it from a domestic currency perspective. Well, if all those revenues being earned in the rest of the world by our large cap companies and what have you, or by international companies, obviously, those foreign returns are going to look a lot better when they're buying way more of the dollar than they were previously. So, checks out. We've seen international outperform this year.
Yeah, absolutely. All right. Well, listen, we're getting here to our end of time. I just want to make a point out there. It's kind of mid-year, and for people that are working and have 401ks or IRAs, it'd be a great time for everybody to check out what they're making in terms of contributions, and thinking about the difference between if you have access to a Roth 401k or 403b, whatever it happens to be. There is a significant difference over a long period of time between the Roth and the traditional. So see what you have at your employer, and it's well worth taking a look at that Roth 401k. Thank you for joining us. For everybody at Good Life, we appreciate you listening, and we'll see you next time. Thanks so much.
The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. Economic forecasts set forth may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly.